Today we'll discuss about one of the important concepts in financial management that is essentially a need of the hour. And today we will discuss such concept, and that concept is known as capital structure. Now, what do you mean by capital structure? Definitely, there are many meanings and definitions that is available in the textbooks, but the very simple definition or meaning that refers capital structure means, it refers to a proportion of debenture, preference, and equity share capital in the balance sheet of a company is referred to as capital structure. That is the most simple and crisp meaning which we can deliver for capital structure. Now, you can see on this slide that, a balance sheet has been presented to you in front of you. And this balance sheet comprises of equity share capital, preference share capital, and long-term loans. And respective to each variable, you can see the amount that has been enlisted. That is equity share capital 10 lakh, preference share capital 5 lakh, and long-term loans 2 lakh. Now here, when you get these variable in your hand, how do you compute capital structure? It's very simple. As I told you, it is a proportion. So how can you find out the proportion out of this? That is, you can add all these three variables, that is 10 lakh, 5 lakh, and 2 lakh, then you will get 17 lakh in total. And out of this, to find out the proportion of equity share capital, it's very simple. That is 10 lakh against equity share capital divided by 17 lakh, you will get 58.82%. Like that, you can find out proportion of each variables listed in the balance sheet, and obviously this is referred to as capital structure. Now the next term which usually we encounter is capitalization. What do you mean by capitalization? It is very simple. Capitalization refers to the total amount of securities that is shown in the balance sheet. For example, the same problem, if you take, all the balance sheets are being given to you, all the variables and the amount related to these items are given to you. If you sum total all the three, that is 10 lakh, 5 lakh, and 2 lakh, you will arrive at 17 lakh. And that 17 lakh is referred to as capitalization. Next, along with this, the other important concept which we must be aware of is financial structure. So usually we will be confused with the term capital structure and financial structure. But to avoid that confusion, it is very simple. Financial structure means it refers to all financial resources. That is not only long-term, but short-term also. But earlier, we discussed about those sources which focused only on long-term. But here, we focus on all the financial resources that that shows a short-term as well as long-term. Now, what are short-term and long-term? Because in the earlier problem, which we have seen that the table has shown three kinds of variables: equity share capital, preference share capitals, and long-term loans. Along with that, if you find out variables like current liabilities, retained earnings, capital surplus, then that is referred to as financial structure, because along with long-term sources like equity, preference, and long-term loan, there are short-term finances, that is retained earnings, capital surplus, and current liabilities. So summed together, it shows the financial structure of the firm. So obviously there is no need of any further confusion. That is, you already know what is capital structure and a financial structure. The major difference between two is capital structure focus on the long term, and the financial structure focus not only on long term but also focus on short term. Now, forms, different patterns of capital structure. If you take a company, what are the patterns or what are the different types of capital structure that can be formed? Obviously, that is a biggest question that comes to us when we look at the balance sheet. Now, there are four different patterns of capital structure. First one is when a company issues equity shares alone, then there arises one form or pattern of capital structure. Second one is when a company prefer to issue both equity and preference, there arises another second form of capital structure. And the third one is when a company prefer to go for equity and debenture, again comes the fourth or the third kind of capital structure. And the fourth one is combination of equity, preference, and debentures. So these are the four kinds or patterns of capital structure which you can normally see in the balance sheet of a company. Now, the most important part is, if you see all this capital structure, obviously, all these capital structure includes, or it says, it communicates that stakeholders have invested in the company. So when stakeholders have invested in the company, obviously, they will be looking for a return. And what is the kind of return? How a company can give the return, or through what source a company can provide return to these stakeholders? Obviously, the answer is in front of us, through profit. So the company can give return to these stakeholders based on profit which they earn from their operating activities. So the returns are being distributed to these various stakeholders in terms of profit. Now, the another question is, you can see on the slide that how this profit can be distributed. In what ways the profit can be distributed? It is separate. It is based on different stakeholders. Profit can be distributed to each one of us, or each one of the stakeholders. And as per to say that we have three kinds of sources for better understanding. So there are 4 columns you can see in this slide. And first column is about particulars. This shows about how the profit is going to be distributed. The second column focus on equity financing. That is this profit, how this profit is going to be distributed to equity. The second one is debt, how the profit is going to be distributed to the debt financing, or to the stakeholders that have taken debentures of our company. And the third one is preference shares, how the profit is going to be distributed among the preference shareholders of the company. Now, the first item you can see on the slide is EBIT, which means nothing, very simple. Earnings before interest and tax. So earnings before interest and tax means, this shows the profit before you adjust interest and before you adjust tax. Now, in this, you can see that EBIT will be common for any kind of source of financing you take. EBIT will be common for everybody because profit is, it's common in the first stage. From that profit, you need to separate it part to the each equity shareholders as shown on the table. You can see that first item which you must give to the stakeholder is, what could be that? It is interest. You have to pay interest to the debenture holders. That is the first obligation which the company has to meet from the profit they have earned from the operating activity. So first you can deduct interest. And you can see that in the second column of the table, that is in equity financing, there is no change. Why there is no change? Because equity shareholders are not entitled to receive interest. So there is no change for equity. Second column, that is in the third column, you can see that it shows debt financing. So in debt financing, obviously there is an impact. Why there is an impact? Because interest has to be paid to debenture holders. So that has to be clearly mentioned. So that is why that impact arises on the third column. And the fourth column is preference shares. There also you can see there is no impact because preference shareholders are not obliged to receive any interest. They are supposed to receive dividend. So once you deduct interest from EBIT, you will get earnings after interest and before tax. That is EAIBT as shown in the table. So this shows that before deducting tax, this is the current position of profit. Now, let's move on to tax. Usually tax will be mentioned. Tax has to be paid to the government. So it is very common. So from this EAIBT, we have to deduct tax. So tax has to be deducted for each source of finance. And you can see that finally you will get a term called EAT. Don't pronounce it as EAT. Okay, it is EAT. That means earnings after tax. So this earnings after tax you will derive for 3 kinds of stakeholders. After that, next comes the most important thing, that is preference dividends. So that has to be deducted from this earnings after tax. Now, when you deduct preference dividend, where will be the impact shown? Is it on the equity financing? You can see that there is no impact shown on the equity financing. And when you look at debt financing, you can again see that there is no impact on the debt financing because both of them are not entitled to receive any preference dividend. And the third one, that is preference shares. If you look at preference shares, they are supposed to receive preference dividend. Hence, that has to be deducted from the third source or equity or stakeholders. And when you deduct it, you will get earnings available to equity. So, obviously, you have paid the interest. That is, your obligation to debenture holders are finished. Then you have paid tax. Your obligation to government is completed. Then you have paid preference dividend. So your obligation to preference shareholders are also met. And finally, you have already arrived earnings available to equity. Now this amount is as a whole is in hand of equity shareholders. Now, you already got earnings available to equity. As in the table, it is clearly mentioned, earnings available to equity. Next is, how many equity holders are there in your firm? Because we have to know how much each equity shareholder is supposed to get, or what is the income which each shareholder is supposed to get. So obviously, next item, that is second last item, is number of equity shares. How many number of equity shares are available in the company? So based on that, you can write the number of equity shares for each source of financing. Then you can divide that. That is earnings available to equity divided by number of equity shares. You will get the final and the most wanted answer, that is EPS, which is known as earnings per share. So this is how a profit is being distributed to each shareholders. When a profit is distributed to debenture holder, definitely you will get earnings after interest and before tax. From that profit, if you deduct tax, you will get earnings after tax. And from that, when you pay dividend to preference shareholder, you will get earnings available to equity. And from these earnings, if you divide number of equity, then you will arrive at earning per share, which means this is the income which each equity shareholders are supposed to get from the company for their investment. Next, as you can see, is a problem, just to make you more aware about this, because usually you will be encountered with the problems in financial management, and this is one of the important problem which will be asked in usually all kind of question papers. You can see that, and in all kind of questions or all kind of university exams, you can experience such kind of questions. So I've taken this and I've tried the basic things to break it into a very smaller part, so that becomes easy for you to understand and grasp the important things. So you can see here that ABC is a company, so they already have an equity capital. And it is clearly mentioned 15,000 equity shares of rupees 100 each. That means the total amount of equity share capital will be how much? 15,000 into 100, that comes around 15 lakhs. So that is what you will get. Next, so already they have 15 lakhs of capital in terms of equity. Next is, again, management is planning for an expansion. So when they plan for an expansion, they need 25 lakhs. So 25 lakhs is what they plan to expand. And how they are going to take this 25 lakhs, or how they are going to source this 25 lakhs. So they are going to source this 25 lakhs, and three options have been given to you directly. The first option is, you can source 25 lakh by issuing 25,000 equity shares of rupees 100. It is mentioned. Second, you can issue 25 lakh with the issue of 25,000 debentures with 8% interest of rupees 100 each. And the third option is, you can source this 25 lakh by issuing preference share capital. That is by issuing 25,000 shares of rupees 100 each at 8% dividend. Now, in the problem, it is directly mentioned what is EBIT. EBIT is already been mentioned here. It is around 8 lakh. Now, you can assume a corporate tax of 50%. Now, based on this, you are supposed to find out how much will be the EPS when you employ each kind of source of financing. That is, if you rely only on equity, how much will be the EPS? If you rely only on debenture, how much will be the EPS? If you rely only on preference shareholder, how much will be the EPS? So this is what you can find out from this problem. So when you take this, definitely again we are putting forward the same kind of table which has 4 columns. That is, one is particulars, the second one is equity financing, the third one is debt financing, and the fourth one is preference shares. Now EBIT, as I told you, EBIT is common for all the sources, and you can write 8 lakh, 8 lakh and 8 lakh for equity, debt and preference. And next item from EBIT, the next item you need to deduct is interest. So you deduct interest. Now, is interest is applicable for equity financing? No. Then is interest is applicable for debt financing? Yes, because we need to pay interest to the debenture holders. So that we will clearly write. So how much amount we need to write as interest? You know that you are going to source 25 lakh as debentures, and for 25 lakh you need to pay 8% as interest. So 8% of 25 lakh is how much? 2 lakh. So that 2 lakh is clearly mentioned in the table. So that 2 lakh will be given. And for third option, preference share, there is no interest. So now you can deduct it and you will get earnings after interest before tax, which is 8 lakh, 6 lakh and again 8 lakh for preference shares. The next important item which you must deduct is tax. So tax rate, they have already been mentioned, that is 50%. So the 50% of tax, that is 50% of tax must be deducted from earnings after interest and before tax. So if you do that, 50% of 8 lakh from equity financing is 4 lakh. So first item for tax is 4 lakh, we got it. And you know that earnings after interest before tax for debt financing is 6 lakh. And if you deduct 50% tax, you will get 3 lakh. Then for preference shares, it is 8 lakh. And if you deduct 50% tax on preference share of 8 lakh is 4 lakh. You can deduct this item. You will get earnings after tax as shown on the table. And earnings after tax is 4 lakh, 3 lakh, and again 4 lakh. And the next is preference dividend. So that preference dividend has to be deducted from this. So you know that it is not applicable for equity financing, it is not applicable for debt financing, it is applicable for preference shares, correct? So that has to be again deducted. So 8% of again 25 lakh, which comes around 2 lakh, you can deduct that. When you deduct, you will get the final, not the final, the essential thing, that is earnings to equity. So earnings to equity which you derive is 4 lakh, 3 lakh and 2 lakh. And along with this, you can find out number of equity shares. Now the question is, how do you find out number of equity shares? If you scan the question again, you can see that it is clearly mentioned. There are 25,000 equity shares for the first option. For the second option, there are no equity shares because they are issuing debentures. So for second option, that is for debt financing, there is no equity. And on the third option, it is preference, not equity again. So again, equity shares are 0. For the second, that is debt financing and preference share financing, there are 0 equity shares. But for equity financing, again, you are issuing 25,000. That is 15,000 you already have, plus 25,000 again, that will come 40,000. So the number of equity shares for first option, equity financing, is 40,000. For debt financing, obviously the existing 15,000 will be taken because there is no other equity involved. So 15,000 there. And for preference shares, again, you are taking 15,000 because there are no further equity being issued. Now you can easily find out EPS. So next we can find out EPS, that is earnings per share. So that is derived by earnings to equity divided by number of equity shares. So EPS for first option is 10, for second option it is 20, and for third option it is 13.33. So when you look at this problem, definitely you'll get an idea about how the profit is being distributed and how this profit comes to the hand of different stakeholders. And different stakeholders here are equity, debenture, and preference. So here the main objective of this problem was to find out finally how do we arrive at earnings per share. And obviously most of the companies are looking for those option that increases the maximum earning per share because equity shareholders belongs to the owner's capital. And obviously, all the firms and all the investors are on the lookout for those company that has maximum or that shows maximum EPS. So here you can say that the maximum EPS is shown for debt financing. That means there is a debenture. When there is a content of debenture in the capital structure, there arises the maximum value for earnings per share. And that gives an additional opening for a concept called financial leverage, which we'll discuss in the next session. Thank you.